Hello everyone and welcome back to these sessions on economics for finance. Friends, in this class we are continuing with the topic national income. As per your study material, the first chapter, first unit, that is concept and determination of national income. In the previous classes, what we have done, we have completed just one method of determining national income, and that was value added method. In this class, I am going to introduce the next method, that is the income method for determining national income. So, if you can recollect, when we started this topic, that time itself I told you that there are three methods: value added method, the income method and the expenditure method. So, income method is basically summing up income of all the factors of production. And you very well know that there are four factors of production: land, labor, capital, enterprise. The land will be given rent, the labor will be given wages, the capital will be provided with interest, and enterprise will be earning the residuary income, which is called as profit. Now, what happens? The payment made in the form of wages or salaries, that is the compensation to employees, is one of the biggest factor in value addition. So, we consider that as one major component of cost, and then other three components like rent, interest and profit, it is summed up as operating surplus. So, if I want to add the income of four factors of production, we begin with wages, salaries, whatever you say, we better call it technically compensation of employees or compensation to employees, and to that we add other three factors income, that will be rent, interest and profit, and aggregate of rent, interest and profit we call as operating surplus. So, compensation of employees plus operating surplus, which is rent plus interest plus profit, and to that we add a few more components and we can directly arrive at the gross domestic product, but it will be measured at factor cost. So, understand, when you are going with income approach, you are never going to land up at the market price, because you are summing up income for all the factors, and therefore you will be arriving at the factor cost base. This is the major difference between the value added method. Value added method initially starts with the market price base, and then you land up to the factor cost base by making certain adjustments. When you are talking about income approach, the first thing that you have to keep in your mind, that you will get started with the factor cost base. If you want to arrive at the market price base, then you have to make adjustment of that net indirect taxes. You know that market price base and the factor cost base, the adjustment that is required between these two parameters, it is the net indirect taxes, that is indirect taxes collected by government and subsidies given by government. Now, what I would suggest you to understand is, under the income approach, we would first land up at gross domestic product at factor cost, and if you can arrive at GDP at factor cost, then how to connect GDP at factor cost with all other parameters, it is extremely simple for you. Am I right? It is extremely simple for you. In the earlier classes we have practiced out lots of situations, and we have seen that how to connect one factor with the other factor, that is one parameter of national income with another parameter of determining national income. So, your initial start point over here will be gross domestic product, that is GDP at factor cost. And how are you going to begin? Four important factors of production: land, labor, capital and enterprise. Their rewards will be summed up. So, that will be income for all the factors, where you have to begin with wages, which we technically call as compensation of the employees, and then the other three factors income will be summing up together and calling that as operating surplus. Once you add up these four factor income, To that you have to add two more factors. Don't forget that we are talking about gross domestic product at factor cost. The term gross means depreciation has to be included. So if I am considering only factor income, it is basically the net income. If I add back depreciation, I'll be getting the gross value. So depreciation will be one component, and not to forget, there will be certain people who are self-employed and their production and services are not out of a big entrepreneurship. It is basically an individual proprietor who are self-employed. For example, a single practicing chartered accountant who is just doing one small practice. So as such, no employees involved. It's not an organization. It's an individual who is generating income for himself or herself. In that case, you would see that such an income should also be included with all other factors income. So that is what we call as mixed income of people who are self-employed. We can simply call it as mixed income of self-employed. So if you crystally understand this thing, it's very, very simple. You are going to sum up the payments to the four factors, which will be income of the four factors of production, and your starting point has to be the compensation of employees, then which is basically the wages paid to the labor. So compensation of employees will be the first point. Then the other three factors income, that is rent, interest and profit clubbed together, which we call as operating surplus, that is the second component. Next component will be the mixed income of self-employed, and yet one more component will be depreciation, because we want to arrive at gross domestic product at factor cost. However, if you are determining net domestic product at factor cost, everything remains same, just don't include depreciation over there. So to sum up, if I am adding income of four factors of production along with mixed income of self-employed, I get net domestic product at factor cost. If I further add depreciation, I get gross domestic product at factor cost. Once you get these factors, these bases of determining income, you can just connect with other parameters and you can determine anything that you want. Not to forget, there are 8 different parameters that we have been learning. You know these parameters very well. GDP at market price, GNP at market price, NDP at market price, NNP at market price, then GDP at factor cost, GNP at factor cost, NDP at factor cost, NNP at factor cost. These 8 parameters is what I am talking about. When you are talking about the income approach or the income method, you are going to begin with either GDP at factor cost or NDP at factor cost. And now onward, when I give you questions to solve, it will require the base of all what you have learned earlier plus this point what I am discussing with you. So let us do one thing. Let us write some important notes in this regard and let us then start solving questions. So in your notebook, make sure that you have written this heading, determination of national income by income method. Write this heading, determination of national income by income method. And once you write this heading, under that heading, let us write some important notes over here. Gross domestic product at factor cost. I have already explained it to you. You just need to write it. So GDP at factor cost, it will be compensation of employees plus operating surplus, which is aggregate of rent, interest and profit, plus mixed income of self-employed and plus depreciation. If you do not include depreciation and other things remaining as it is, then you will arrive at net domestic product at factor cost, that is NDPFC, which will be compensation of employees plus operating surplus plus mixed income of self-employed. So please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this much, let us do one thing. Let us take up some initial calculative examples to understand and put this under our command, and we will begin with question number 6 from your book, and let us read this question. From the following data, calculate NNP at factor cost, NNP at market price, GNP at market price and GDP at market price. These 4 things they have demanded, and the information what you have is in the form of operating surplus, mixed income of self-employed, rent, profit, net indirect tax, consumption of fixed capital, net factor income from abroad which is given as a negative value, and compensation of employees. Now I will not say a word further. You have enough information to do the required calculations. I'll give you 4 minutes time to try out these 4 calculations. Please do not write anything in your fair notebooks. Do it as a rough work. If you are not able to get the answers, I'll help you out, but I'll be happy if you can do the calculation without my help. So I have given you 4 minutes time, and your time starts now. Alright friends, I think I have given you enough time and opportunity to try out these calculations. So let us see what will be your answers over here. Gross domestic product at market price, if we want to compute, we can start with the compensation of employees, add mixed income of self-employed, add operating surplus, add depreciation and net indirect taxes, and we get GDP at market price as 4950. If we want to find gross national product at market price, it will be GDP at market price plus net FIFA. Net FIFA was given as a negative, so it will be 4950 plus negative 50. In other words, it will be 4950 minus 50, that is 4900 crores. Net national product at market price will be GNP at market price minus depreciation, that will be 4900 minus 400, that will be 4500 crores, and NNP at factor cost or national income will be NNP at market price minus net indirect tax, so it will be 4500 minus 450, and that will give you 4050 crores. So please make sure that you got all these answers. I'll give you a calculation in an alternative manner as well, but first you write this whole thing as part of your solution. Alright friends, I'm sure you have completed writing this whole thing. It actually puts an end to the solution. I'll just show you some alternate ways of determining these calculations. So you may directly compute GDP at factor cost by taking compensation of employees, add mixed income of self-employed, add operating surplus, add depreciation, and you get GDP at factor cost directly. Then GNP at factor cost will be GDP at factor cost plus net FIFA. It will actually get subtracted, and that comes to 4450, and NNP at factor cost will be GNP at factor cost minus depreciation, and that will be 4450 minus 400, that will be 4050. You can approach the calculation even this way. So this is just an alternate way of presenting the NNP at factor cost. So please write up this whole thing, and that will be end of the solution. Alright friends, once you are done with this entire solution, let me take you ahead and let us take up question number 7. Let us read this question. It says calculate national income by value added method with the help of following data. Now here you are asked to follow a particular method, that is value added method. Therefore you are not supposed to follow any alternative method to compute this national income in this case. So I will give you exactly 3 minutes time to do the required calculation, and please take this time productively for yourself and make sure that you don't write anything in your fair notebook. You know the drill. You should try making the calculation as a rough work, and then once I show the solution, you can note it down in your fair notebook. Your time starts now. Alright friends, I have given you enough opportunity to try out the calculation. Let me now show you the solution and see whether you could do it correct or not. Because we have been asked to use value added method, we go with the value of output, that will be sales plus closing stock minus the opening stock. So the value of output will be 700 plus 400 minus 500, it comes to 600. Intermediate consumption is given as 350. So value added, that is GDP at market price, comes to 600 minus 350, that will be 250. Net FIFA, that is net factor income from abroad, is given as 30. So GNP at market price will be 280, that is A plus B. And from this, when you subtract depreciation, you get NNP at market price as 130. So NNP at factor cost will be NNP at market price minus indirect tax plus subsidies, and what we get is 130 minus 110 plus 50, and that would give you exactly rupees 70 crores as your net national product at factor cost. So once you complete writing this whole thing, it will be end of the solution. And most importantly, you must follow this particular approach necessarily, because the question has emphasized on this particular approach. Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question, that will be question number 8. Let us read this question. Calculate net value added by factor cost from the following data. They have given sales, depreciation, opening stock, closing stock, excise tax. Let me tell you what is excise tax. Excise is just yet another form of indirect tax. Okay, nowadays it is GST, but earlier it was excise tax. So excise tax is nothing but just an indirect tax component. Then we have intermediate consumption and subsidies. So you have to try it out. I'll give you same 3 minutes time to try out the calculation, and your time starts now. Alright friends, I'm sure you have utilized your time very well and you have cracked the answer by now. So let us check whether you did it correct or not. So we begin with the value of output, which will be sales plus closing stock minus the opening stock. So that will be 450 plus 30 minus 40, and that will be 440. From the value of output we subtract the intermediate consumption, that is 200. We get value added, that will be GDP at market price as 240. From that, when we subtract depreciation, we get NDP at market price, that will be 210. Of course we are talking about rupees in crores. NDP at factor cost will be NDP at market price minus indirect tax plus subsidies. So when you do that adjustment, what you get is 180 crores as NDP at factor cost. So please make sure that you write up the whole solution systematically, and then we proceed ahead. Alright friends, once you have completed writing this entire solution, let us move ahead and take up next question as question number 9. Let us read this question first. Calculate the aggregate value of depreciation when the GDP at market price of a country in a particular year was rupees 1100 crores. Net factor income from abroad was rupees 100 crores. The value of indirect tax minus subsidies was rupees 150 crores and national income was rupees 850 crores. Now guys, if you are clear with the definition of each component, the missing value in the entire question is the amount of depreciation. I'll give you again 3 minutes to try out this calculation of depreciation. If you can do it correctly without my help, that will be great. Your 3 minutes time starts now. Alright friends, I have given you enough time to try out the calculations and let us now see whether you got things correct or not. Given GDP at market price is 1100 crores, net FIFA was 100 crores, net indirect tax was 150 crores, NNP at factor cost 850 crores. That is basically the national income. So GDP at factor cost will be GDP at market price minus net indirect taxes. So GDP at factor cost will be 1100 minus 150. Thereafter, what we get is 950. So GNP at factor cost will be GDP at factor cost plus net FIFA or NFIA, and that will be 950 plus 100, that gives you 1050. Net national product at factor cost, that is the national income, it will be GNP at factor cost minus depreciation. Now what we know is NNP at factor cost as 850 crores, correct? This one is 850 crores, and GNP at factor cost we just computed as 1050 crores. Finally, we can conclude that depreciation has to be difference between these two. So when we substitute the values, we get 850 equals to 1050 minus depreciation. So depreciation will be 1050 minus 850. Depreciation itself will be rupees 200 crores. So that will be your final answer. Make sure that you got the same thing, and I am giving you some time to write up the answer systematically, and then I take you ahead. Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question as question number 10. Let us read this question. Calculate national income by value added method. So don't forget, they have asked you to compute national income, and the meaning of national income is what? You know it very well. It is NNP at factor cost, right? However, in this question, look at what they have given. Value of output in primary sector and intermediate consumption of primary sector. Value of output of secondary sector and intermediate consumption of secondary sector. Value of output of tertiary sector, intermediate consumption of tertiary sector. So basically, from different sectors you have been given the value of output and the value of intermediate consumption. That means you can find value added from each sector and then take the aggregate of all the value added, which will give you GDP at market price, and net factor income from abroad is given as a negative value. Net indirect tax and depreciation also informed to you. I will now not say a word beyond this. I'll give you exactly 3 minutes time to try out this entire solution, and you know the drill. You have to do it as a part of rough work, and when I show the solutions over here, you should then note down those solutions in your fair notebook. So please try out this from your side. I've given you 3 minutes time and your time starts now. Alright friends, I am sure you have taken your time and attempted the calculation. I have given you enough time to do that. Let us see whether you got it right or not. Gross domestic product at market cost or at market price. You can take value of output in primary sector minus the intermediate consumption of primary sector, then add the value of output in secondary sector and subtract their intermediate consumption, and do the same for tertiary sector, and when you get this, it will be GDP at market cost or GDP at market price. Once you get GDP at market price, you need to make some more adjustment to arrive at the final answer, but before we do that, please write up this much quickly. Alright friends, once you have completed writing this part of the solution, let me take you ahead so that you can complete the other things, because we have to finally compute net national product at factor cost. So GDP at market price will be 4,800, add net factor income from abroad which was a negative value, and less the net indirect taxes and less the depreciation, and you get the net national product at factor cost, which is basically national income, and that works out to exactly rupees 4,000 crores. So please write up this whole thing, and that will be end of this solution. Alright friends, once you have completed writing this whole solution, let us move ahead and take up another question for practice. That will be question number 11. Let us read this question. Calculate the operating surplus with the help of following data. Now they have given sales, compensation of employees, intermediate consumption, rent, interest, indirect taxes on net basis, consumption of fixed capital, and mixed income. Now this is the data given to you, and the question is asking you to determine operating surplus. You should not forget that operating surplus itself is an aggregate of three components, that is rent, interest, and profit. So I'll give you exactly 3 minutes time to try it out. If you are not able to do, then I'll help you, but you try your best that before I present the solution, you should be able to do the calculation, and as usual, do the calculations as a rough work, and once I show you the solution, you should look into whether you have done it correct or not. As I told you, I'll be giving you 3 minutes time, and your time starts now. Alright friends, I have given you sufficient time to try it out. Let us check whether you got the calculations correct or not. Gross value added at market price will be the gross value of output minus intermediate consumption, and we have basically the value of output as sales plus change in stock minus intermediate consumption, and that will be 4000 minus 600, that is 3400. Now GDP at market price is gross value added at market price, which is 3400 crores. NDP at market price, net domestic product at market price, means converting gross to net. So basically you want to subtract depreciation. Here the term depreciation has been given in the question in the form of consumption of fixed capital, which is by value 200 crores. So what you get as NDP at market price will be 3200 crores. The next thing that we are calculating over here is NDP at factor cost, which is NDP at market price minus net indirect taxes, and that will be 3200 minus 500, that is 2700 crores. So please write up these calculations and then I take you ahead. Alright friends, once you have completed writing this part of the solution, let us move ahead and continue further. So net domestic product at factor cost is basically compensation of employees plus operating surplus plus mixed income. You know it. Let us put up all the values. So operating surplus is the missing value in that equation. When you solve it, you get the operating surplus as rupees 1000 crores. That will be end of this solution. So please write up and then we move ahead. Alright friends, once you have completed writing this solution, let us move ahead and write the next heading, that is determination of personal income. Please write up this heading, determination of personal income. Now once you have finished writing this heading, let us talk about what exactly is personal income. So friends, look into one thing, that when we are talking about arriving at national income, and if you look into that income earned by the household, is that going to be matching with the national income? The answer is no, it will not. Because let me give you certain examples. There is a component called transfer payment. There is a component called transfer payment. For example, suppose government has a scheme of providing compensation to the unemployed. So suppose some people who are unemployed, but they will have to still survive, right, until they get employment. Suppose government is providing some compensation. So imagine that there is a household where there are 4 members, and the main bread earner, one person who is the main bread earner, that person is unemployed, and suppose government is providing monthly compensation to such household. Until the person gets employed, certain compensation is being given. So logically, if you see from the viewpoint of the household, it is basically the income for the household, but that money was never earned. It was just a transfer payment from government's pocket to the household. Likewise, when there are payments made by household to government, even that will not be considered as part of national income. So what you need to understand is, you should be clear with one thing, that there may be 2 important components: income which is earned but not received, and amount that is received but is not an income. Let me give you example again. So I was talking about the compensation of employees. It is basically the money received by the household, but that is not part of national income, but it will be part of personal income. However, sometimes income is earned, correct, but that money doesn't come to the household. For example, look at this way, there are companies who have earned profit. Profit is earned for whom? For the shareholders, but company may not distribute entire profit in the form of dividends. Therefore, that can be undistributed profits, which you would have learned in financial management as retained earnings. So retained earnings of companies are basically the part of the profit which is earned by the company for all the shareholders that belongs to the household sector, but that money is never coming in their hand. So when you are computing the personal income of the household, you are not supposed to consider that component of income. So it is income earned but not received. Transfer payment is the other way example, where income wasn't earned but money was received. See, transfer payments may not necessarily come from government. Transfer payments can come from rest of the world also. Let me give you some extreme examples. In India, we have seen that there were natural calamities in the past, and the governments and entities outside India, they have seen that for such an adversity that the country has faced, let us provide some compensation, some kind of help to this particular area. So what they do is, they provide some money to the household for their survival during this situation of calamity. It could be a case where there is a heavy earthquake or a tsunami has hit, and that is a time when not only Indian government, but governments of other countries or big MNCs outside India may also provide some financial help to the household. That is also basically a transfer payment. It was never part of national income, but from the household viewpoint, there is an inflow coming in. These are what we call as transfer payments. On the other side, incomes which are earned but not coming in the hands of household could be, number one, corporate taxation. Another example could be retained earnings or undistributed profits. So if you can just adjust these two components with national income, so I give you a broader picture. Consider national income. To that you add payments received which are not forming part of income, and deduct the amount which is included in the national income but was never received in hand by the household. This logic, if you fit in your mind, you will get to arrive at personal income. One more adjustment you do and you can arrive at yet another connected component, that is disposable personal income. Now what is this disposable personal income? Income which is earned by household. Every household will have to pay income tax, right? So you are earning some income that is part of your personal income. Out of that you have to pay income tax. Now I am not talking about the corporate tax. Corporate tax was not forming part of personal income only, because it was part of national income but it never came in the hands of household. It was deducted then and there. So you are supposed to subtract corporate tax before even arriving at personal income. But when you arrive at personal income, out of the income earned, these households will have to pay personal income tax, and that will be from the income that they have earned. So for example, I have earned an income of rupees 100. So I am representing a household and I have earned an income of rupees 100, and I have to pay suppose rupees 10 as personal income tax. So the money that stays in my hand as my income at my disposal will be only rupees 90. So it could be tax that I have to pay to government, that is income tax, and we will specifically call it a personal income tax. So we have two types of income taxes. One that is charged on corporate entities, that is corporate tax, and one that is charged on individuals and households, that will be generally referred to as personal income tax. Now there may be sometimes certain other payments which are not precisely tax but compulsory payments that the individuals will have to contribute to government. For example, in certain states in India, we have a professional tax payment requirement. It's a nominal amount but still it is required to be paid. So it is not actually income tax but another form of compulsory payments to be made by households to the government. Such payments will not be in the hands of the household for their disposal. So when you arrive at disposable personal income, you should be very clear that personal income minus the personal income taxes, and also subtract if there are any other such compulsory payments to be made by household to the government. All compulsory payments to be made by household to government you deduct, and then you arrive at disposable personal income. So let's do one thing. Let me give you some note about this, and then we can start solving questions with respect to determination of personal income and disposable personal income. So let us first write these notes. So personal income. While national income is income earned by factors of production, personal income is the income received by the household sector. Personal income is a measure of actual current income receipts of persons from all sources which may or may not be earned. For example, transfer payments such as social security benefits, unemployment compensation, welfare payments, etc. So please write up these notes. I have already explained to you. Just write it quickly so that we can move ahead. Alright friends, once you have completed writing this much, let us move ahead and continue writing further. Individuals also contribute income which they do not actually receive. For example, undistributed corporate profits, which I told you earlier as retained earnings, and contribution of employers to social security. Now, I'm sure within the subject income tax, you would have learned something about social security payments. So, employers, what they do is, on behalf of their employees, they make a contribution on their behalf to government, that is contribution of employers to social security. So, when you count the income of the employee, you may consider this as part of their income, which could be taxable income for them, but they never received this money, right? So, this should not be considered when you are determining the personal income. So, personal income excludes retained earnings, indirect business taxes, corporate income taxes, and contributions towards social security. Households receive interest payments from the firms and governments. They also make interest payments to firms and governments. As such, the net interest paid by a household to firms and government is also deducted from national income. This is basically in order to arrive at personal income. So, first write up this, and regarding interest payments, I am going to give a little elaborate explanation after this, but first you complete writing this much. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. So personal income basically equals to national income plus income received but not earned minus income earned but not received. So to go into a little more details, we would say personal income will be national income minus undistributed profit plus interest received by household from Government of India minus corporate taxes plus transfer payments to the household. And let us write some note over here. Income received but not earned means transfer payments. Income earned but not received means undistributed profits of business and corporate tax. So just one small thing over here before you write, focusing on this net amount is interest received by a household, that is why you are adding. If it is interest paid, you would subtract. That one precaution you'll have to take. Okay, so I'll do one thing, that other version of this definition also I'll show you, where the net amount is not interest received but the net amount is interest paid, and that is the time you will be putting this as a minus sign instead of plus sign. So but before I make you write that, first you write what you find on screen right now. Write it quickly and then I take you ahead. Alright friends, I am sure you have finished writing this whole thing. Now one small point that I want to bring into your notice, focus on this definition. If there is any interest received by a household from Government of India, you are adding it. Inversely, if the net amount of interest is paid by the household, you are going to subtract it. Okay, so just the other version of that definition if I put on screen over here. I would say the net interest payment made by household. So earlier it was net interest received, you added that, net interest payment you should subtract. So just write up this part, or you may write a small note that if it is net interest payment made by the households, it should be subtracted. Whatever is convenient to you, just do that, and then I take you ahead. Alright friends, once you have finished writing this whole thing, let us move ahead and now write a note about disposable personal income. It is a measure of amount of money in the hands of the individuals that is available for their consumption or savings. So disposable personal income will be personal income minus personal income tax minus any other payment made to the government. So please write up this as well. I have already explained it to you, and once you finish writing this, we move ahead. Alright friends, once you have completed writing these notes about disposable personal income, let us move ahead and start solving questions linked with this concept. Question number 12. Let us deal with this. It says, from the following data, estimate national income and personal income, and they have given net national product at market price, income from property and entrepreneurship accruing to government administrative departments, indirect taxes, subsidies, savings of non-departmental enterprises, interest on national debt, current transfers from government, current transfers from rest of the world, savings of private sector, and then corporate profit tax. If this much is informed and you are required to compute national income and personal income, you should understand that national income precisely means net national product at factor cost, and what is given to you is net national product at market price. You have to convert the market price base to factor cost base, and you will easily be able to arrive at national income. Once you have landed at national income, it is very easy for you to arrive at personal income based on what we have just learnt. So let us look into how to present the solution. You start with national income calculation, which will be NNP at market price minus indirect taxes plus subsidies. All figures are readily available. 1746 crores will be your answer. So just write these couple of lines first and then I take you ahead. Alright friends, once you have completed writing these a couple of lines, let us move ahead and take up the next part of our discussion, that will be computation of personal income. And you have already computed national income as 1746 crores. From this you will subtract the income from property and entrepreneurship accruing to government administrative departments, subtracting savings of non-departmental enterprises, then adding the national debt interest, adding current transfers from government, adding current transfers from rest of the world, subtracting savings of private corporate sector, and also subtracting corporate profit tax, and what you will get at the end is the amount of personal income, which will sum up to 1711 crores. So please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this solution, let us move ahead and take up the next question. That will be question number 13, and let us read this question. On the basis of following information, calculate NNP at market price and disposable personal income. So what is given over here is NDP at factor cost, income from domestic product accruing to the government, interest on national debt, transfer payment by government, net private donation from abroad, net factor income from abroad, indirect taxes, direct taxes, subsidies, taxes on corporate profits and undistributed profits of corporations. With this information, you are supposed to calculate NNP at market price and then the disposable personal income. So how do you start solving this question? You first define how to compute NNP at market price. It will be NNP at factor cost plus indirect tax minus subsidies. So understand, this time you are arriving at NNP at market price from the factor cost base. So it's a kind of reverse calculation, and NNP at factor cost will be NDP at factor cost plus net FIA, and NDP at factor cost is given in the question as 14,900 and net factor income from abroad is given as 80. So we get NNP at factor cost as 14,980. Now to 14,980, if you add indirect tax and subtract subsidies, you will be able to arrive at net national product at market price as 15,053. First write up this part of the solution and then I'll show you how to arrive at disposable personal income. Alright friends, once you have completed writing this much, let us move ahead, and from the information about national income, we will arrive at personal income first of all. So you can start with NNP at factor cost, which is the national income, subtract income from domestic product accruing to government, add interest on national debt, add transfer payment by government, add net private donation from abroad. Even net private donation from abroad is nothing but a type of transfer payment, minus taxes on corporate profits and minus undistributed profits of corporations, and that will give you personal income as 14,763. So once we arrive at personal income, with a little adjustment we can easily compute disposable personal income. So please write up this calculation as well, and then I take you ahead. Alright friends, once you have completed writing the calculations up to this personal income of 14,763, moving forward we compute disposable personal income just by one small adjustment, that is from personal income you subtract the personal income taxes and you get the final answer as 14,663 crores. So please write up this one line calculation, and that will be end of this solution as well as end of this session.